start with the bull and the bear views on the US economy. So as far as the bull views are concerned, we'll start with that. One is obviously the monetary stimulus, which is a 25 basis points rate cut is now almost a certainty. The options market is giving a 90% probability to a 25 basis points rate cut in September meeting for the US Fed. And most of the times, the US Fed's analysis by the options market has been fairly accurate. And so, yeah, 25 basis points rate cut is almost a certainty. Now there are even talks about a 50 basis points rate cut, which will be very stimulative if it does happen. So we'll see. Now our expectations are somewhere between a 25 to a 50 basis points rate cut in the September meeting. And the next meeting is in September. There is no meeting in August. So that's monetary stimulus, which is a big deal. Obviously, rate cuts typically are very good for stock market returns. And then the other theory that the bulls put forward is the fiscal stimulus. So we talked about monetary stimulus with the rate cuts. Next is fiscal stimulus. The one big beautiful tax bill, which was just passed as a law about 15 days back. I think that bill has quite a few provisions for tax cuts, both for corporates as well as individuals. We'll get into some of those details in the later slides. But that provides a lot of stimulus to the US economy. So that's another reason why the bulls are arguing that the stock market's returns will be quite positive over the next couple of years. And last but not the least, the EPS growth of US large and mid caps, it's pretty robust. We are expecting a 9 to 10% EPS growth for CY25 and slightly lower, but 8-9% EPS growth for CY26. So given that type of EPS growth, I think it's, and including the fiscal and monetary stimulus, it sets up a good environment for decent stock market returns. Historically, when both fiscal and monetary stimulus are combined for any economy, forget the US economy, it is very bullish for the stock markets, and it's almost an unbeatable formula for good stock market performance. So it's a very potent combination when you have monetary as well as the fiscal stimulus, which we are going to see in the next 1 year or so. It is just the beginning, and it will be implemented over the next 1 year. So a wonderful setup for good stock market returns. Now on the bear side, a lot of bears argue that inflation is going to be higher from the tariffs, although we'll discuss later on why it doesn't matter in the near term, and over the long term, the companies do get a chance to adjust their supply chain. And so the impact of tariffs will be blunted, but yeah, there will still be some impact. You can expect some sort of price increases for US goods, for US consumers. And that is why inflation will increase, and that will likely reduce some of the discretionary spending. As prices increase, people reduce their discretionary spends. So that is the bear thesis, which definitely that will work out. Now, up to what extent it'll work out, that's the only question. The next point put forward by the bear camp is net new job creation. The jobs report released yesterday was 73K new jobs created versus 104 that was expected. So that's a negative. And both April and May jobs were revised lower by a significant amount. So that's also a negative. Most of these job losses, because this 73,000 number is a net new job creation, which means any job losses that happened during June were a negative to that number. And most of that negative number came from government sector layoffs. Dodge, which was the Department of Government Efficiency, which was headed by Elon Musk till he left, that was responsible for a lot of layoffs in the government sector. And that is impacting the jobs numbers that you're seeing right now as a net negative. Housing starts are declining. Housing is a big part of the US economy, so declining housing starts doesn't bode well for job creation. Obviously, that is also hurting the job creation. And subsequently, those are the few points that are put forward by the bear camp. However, as far as BayFort's view is concerned, we do feel that the monetary and fiscal stimulus will overpower the negative effects of the inflation, lower job creation, as well as lower housing starts. And finally, a lot of this, whatever the bears are claiming, has already played out. For example, jobs, they're already declining for the last few months. Housing starts are already declining for the last few months. Some of the inflation has also been factored now. So a lot of the bad news is already factored in, while the impact of the fiscal stimulus, which is the tax bill, is just 15 days old. So that hasn't seen or is not seen in the economy as yet. And we'll discuss some of the major impacts of that fiscal stimulus bill. And on the monetary stimulus, September is still about a month and a half, 2 months away. The Fed meeting in September, and that obviously has not played out the rate cuts. So once the rate cuts are implemented, then we will see the impact of that on the economy in the next 6 to 9 months. And so I think while all the bear theories have already played out in the stock market or in the economy, the remediation to that, which is in the form of fiscal and monetary stimulus, that has just started. It's a 15-day-old story, and it is going to continue for the next 1 year. So I think as that story takes hold and the impacts of the fiscal and monetary stimulus are seen in the economy, the stock market will definitely, I am expecting the stock market to react very positively to the stimulus measures. So that's our view between the